Hi friends, Tony DeWitt here, Missouri appellate attorney and a guy who likes to make the law make sense on YouTube. Here's what we're discussing today. If there is one thing, one device in my life that has caused me more problems than pretty much any other thing, it's one of these. That's right, a credit card. There's a reason for that, because if you don't know how to manage money, if you've never been taught how to manage money, or worse, if you had parents who had no idea how to manage money, many times it makes it possible for you to get a credit card and then wind up in debt for pretty much the rest of your life. It may be a little bit of a surprise to a lot of you who are a little younger than I am, but prior to about 1965, if you wanted credit from a bank, you had to go in and get a loan. There wasn't really much of a way to have an open-end line of credit that you could use at the drugstore and the grocery store and the car dealership, any place like that. No, that didn't happen. What there was, you could sometimes get a 90-day note. You go to the bank and say, hey, I need $500 and I'll pay you back within 90 days. And that worked out pretty good. But for the most part, everything that you got by virtue of going in and making a request for a specific loan for a specific thing. And usually you got that loan only if you had adequate credit and adequate collateral to support the loan. The result of that was that pretty much everyone managed their money out of their checkbook or out of their wallet. There was no readily available consumer credit device that you could use everywhere. Now, of course, gas stations like I think Unico and Unocal and Amoco and almost all of the major brands of gasoline, Shell, they had credit cards to make it easy to go to their gas stations and pay for gas. And of course, a Shell credit card pretty much locked you into buying Shell gasoline. And of course, certain department stores had their own lines of credit. Back before Sears decided to buy Kmart, which is probably one of the dumbest deals that's ever been done in the history of commerce, Sears was this huge chain of stores throughout the United States that had started out as a catalog store and then went to individual stores in big malls. Well, you could get a Sears card. If your refrigerator died as a result of a lightning strike or something like that, well, I have a Sears card, I can go get a refrigerator from Sears. Same thing with Montgomery wards, which in the South was often known as Jefferson wards. They were in the business of selling merchandise, and one way they did that was by extending credit to their customers, assuming, of course, that you paid those credit cards back. You could get a credit card from Dillard's and other places like that, and all of these made it easy to get consumer purchases, but only from those stores. If your local camera store did not have its own credit card or device, you're out of luck. You had to go to the bank, get a loan to buy that camera if you didn't have the cash on hand. This requirement to manage your money carefully and thoughtfully by using your available cash and keeping some back for a rainy day led most people to have fairly productive and usually very frugal lives. Well, these store brand credit cards and the lack of any actual consumer device you could use anywhere, that all changed in 1966 when Bank of America came out with what was called then the Bank Americard. Now, today you know that as the Visa card. Visa got its start with the Bank of America. And other banks took note. The Bank of America now had access to a huge swath of consumers who were hungry for the opportunity to buy items on credit and make monthly payments to the bank. Monthly payments, by the way, that included, in some cases, as much as 21% interest on the balance. Almost always, the bank set the minimum monthly payment such that it would take you 17 years to pay off the balance, assuming that you made that payment every month at the minimum amount to try and do that. So it became sort of this self-extending line of credit to the point where you maxed out your credit card And now you couldn't use it to buy anything, and you had to make monthly payments that were pretty much confiscatory of all of your money. And that created problems. But for many people, for millions of Bank of America customers, that system worked really well. You know, they bought products, they paid off their Bank of America bills at the end of the month, just like they had their gas cards and their store cards and that kind of thing. But those people never had a problem. They understood how to manage credit, that credit was a tool that made it easy to buy something, not easy to pay for something. If you needed something that made it easy to pay for something, you probably had a different problem. And for a lot of people, this created something like an addiction. Think of it as a spending addiction. Rather than looking at a camera at the camera store or the guitar at the music store as something that cost $500, you could now look at it as something you could make a number of easy payments of $23.50 every month, and you'd have that camera and you'd have that guitar while you were paying for it. Wow, what a great deal. You know, usually you had to fork over the cash before you got the camera or the guitar. Now you just go in, slap that card down, and you take it home. You begin to think about things as in terms of a monthly payment. And those of you who have done any shopping for a car know that this is how car dealers sell cars. They don't tell you, I can get you a $500 discount off the purchase price. They say, well, you know, our credit company can get this car for you for $323 a month. And that's a big bargain. Well, it is a big bargain until you realize that it's going to take you 6 years to pay off the car. Oh, and by the way, you're paying 17% interest on it. Credit is a way that banks make a lot of money. And credit card issuing banks tend to make a lot of money every day on the backs of people who don't understand how to manage their purchases or their credit. Now, I'm not saying that banks or credit cards or consumer credit was a bad thing necessarily as such. I'm not saying that credit cards are a bad thing when you use them properly. What I am saying is that many people did not have the discipline necessary to handle all of the buying power they had, which was usually a great deal more than the paying power that they had. Then in the 1990s, Congress, in its infinite wisdom, exempted the interest that was being paid on credit cards from the ability to deduct interest expense off of your taxes. So consumers began to use fewer credit cards because they could no longer deduct the interest, and as a result, the banks came up with another way around that. They set up home equity lines of credit. And of course, home loans are still deductible. So the credit and the interest that's paid on a home equity line of credit, sometimes called a HELOC, H-E-L-O-C, those were still deductible. And instead of writing checks against a home equity line of credit, a lot of banks decided to issue credit cards tied to the home equity line of credit. It was so convenient. You wanted to remodel the kitchen, so you could take your card down to the Lowe's and buy all of the things you needed to remodel the kitchen, and now all of those were tied to this credit card, and the interest that you paid on that would be deductible. It was a good thing as long as you managed it responsibly. Unfortunately, the same people who had problems with credit cards in general tended to have problems with home equity lines of credit. And you can see where this is all going. The banks were, over time, going to own a lot of houses. I talk about this because I lived through it. As a young man, I had a real problem managing credit. I bought a lot of things on credit. I wound up working 2, sometimes 3 jobs in order to pay off all the debt that I incurred. But of course, we pay off our credit cards at the end of every month, which is something that I couldn't do before. But that whole thing gave me a great deal of empathy for people who get over their heads in a debt situation. But for now, let's talk a little bit about what Congress did to regulate the credit industry. Congress a few years ago passed certain statutes that essentially told banks that yes, you can provide consumers a line of credit through a home equity line of credit. But in the event they don't make a payment, you can't dip into their checking or savings account just because they bank with you. You can't do that to collect the balance. In other words, the bank had to go the old-fashioned way to garnish funds if that's what it wanted to do. As you might imagine, that made banks very unhappy, so many of them petitioned the government to make small changes in the rules, and indeed, over time, many of the rules were slackened a little bit through this aggressive lobbying. But one of the rules that remained intact was this home equity line of credit rule through the Truth in Lending Act, and that's what this opinion that I'm going to talk about today deals with. The opinion is out of the Fourth Circuit, and I'll leave a link to that opinion in the description of the video. I could go through that opinion very carefully, but I'm afraid it might be rather boring. That's because it is an opinion at its core that deals with statutory language and what the statutory language means, and how Congress, when they put together these different statutes, used different terms in each of these statutes, and the court essentially had to harmonize the differences in language between the Truth in Lending Act, or TILA, and the Real Estate Sales Practices Act, or RESPA, R-E-S-P-A. Essentially, the Fourth Circuit was asked, what do these competing provisions in different statutes mean when they're all construed together? In that case, a man had opened up a home equity line of credit with a bank that was a local bank that was later purchased by PNC Bank. At some point, he fell behind, and since he had several accounts at PNC, PNC just dipped into those accounts to get itself paid off. He objected, he wrote to PNC, and he told them they had violated the Real Estate Sales Practices Act and that they had an obligation to notify him when they were making changes and that sort of thing. Under the law, they had to answer that letter within 30 days, and it took them well over 90 days to answer that letter. The PNC customer asked about all of this and said, you didn't have the right to go in and get this money out of my account. And they basically told him, yeah, we did. And that was the end of it. They refused to deal or give any of the money back or do anything about that. And in fact, they did it a second time. Well, he'd had enough. So he filed suit in state court arguing that the Truth in Lending Act and the Real Estate Sales Practices Act prohibited what PNC Bank had done. So when the consumer sued in state court, the bank removed the case to federal court. The bank attempted to compel arbitration. And as you can see from many of the cases that I discuss on here, big business loves arbitration because it takes it away from the local courts and the local judges. Indeed, it takes it away even from federal judges and places it with private judges, people who decide these cases on the basis sometimes of the law and sometimes on the basis of their affiliations with these entities that bring them the arbitration cases. The district court ruled that one of the bank accounts was covered by an arbitration agreement and the other was not. So both parties appealed that decision, and the Fourth Circuit said, hey, wait a second. The new rules published under the Consumer Protection Financial Bureau say that you don't get to take anything involving a home mortgage to arbitration. So it has to be tried in court. So it went back to the district court, and once it was back in the hands of the district court granted judgment on the pleadings to PNC Bank. And this time the consumer appealed, and he said there were two questions. The first was whether the bank was right in dipping into his deposit accounts to satisfy debts, and the second had to do with the amount of time it took for PNC Bank to respond to his letter. The bank had 30 days, and it took more than 90 days. The case came down to whether this was a credit card account, a home equity line of credit card account, a credit account plan, non-home secured, or some other variation of all of the different terms that are used by these two statutes to sort of mesh together as to what banks can and cannot do. So the Fourth Circuit decided in this case that the inability to access deposit accounts as set forth in the Truth in Lending Act and the regulations written under that act applied. It reversed the district court's order and sent it back for actions consistent with the appellate opinion. But on the issue of the timeliness of the response under the Real Estate Sales Practices Act, it held that because the Consumer Financial Protection Bureau had issued regulations which exempted home equity lines of credit from requirements of basically a timely response in a consumer case, the second claim by the consumer failed. In that case, the consumer managed to get half of the apple, not the whole apple. But the part that the bank was left with definitely had a worm in it, because it looks like they're going to have to go to trial, and they're going to have to face a jury, and they're going to have to determine whether or not they violated the law, and if so, how much money they owe the consumer. In this regard, the case is a very consumer-friendly opinion. There is a dissent in the opinion, and the dissent argues the Fourth Circuit got it wrong. I don't think they did. The logic inherent in the Fourth Circuit's opinion is based on the idea that different language means different things. That only seems logical. So when the Congress defines credit card plan and credit card account differently, there has to be a reason for why they do that. If you have a credit card account that is tied to a home equity line of credit and you live in the Fourth Circuit, you should take heart. The bank cannot dip into your checking or savings account to secure its payments under the home equity line of credit unless for some reason you have specifically allowed them to do this. Now let me talk a moment about something more important. If you find yourself in credit card trouble, you do have a number of options. You can go to a consumer credit counseling service in your area and ask for help. Many times these consumer credit counseling services can get involved. They can contact the people that you owe money to, banks, credit cards, gas cards, all these folks, and they can get them to reduce the amount of interest being charged and work out a plan where if you pay X number of dollars a month for 24 months, you can completely wipe out your debt. Now that means you no longer get to use the cards in most cases, but that's not a bad thing, that's a good thing, because it forces on you some credit discipline. It says that even though you may want something, if you can't afford to pay for something, you shouldn't get it. And yeah, it is a very painful process. I've talked to a number of people who've gone through it, but at the end of that process, all of them came out on the good side. They managed to get past a lot of problems using the consumer credit counseling service. And of course, the other option, you can go see a bankruptcy lawyer. If you're simply too far in over your head that a consumer credit counseling service can't help you, a bankruptcy lawyer can. So that's what I have for you today. Thank you very much for watching. I hope you found this interesting. I also hope you don't mind that I spared you a long and involved run through an opinion which would probably have been somewhat boring. If you would rather have me go through the opinions, even if they have a lot of technical terms in them, like this one did, please let me know that in the comments. I'd also like to know what you think about this particular opinion. Do you like the result? You can drop those comments down below, or you can email me at the address above. As you know, one of the things that I ask every time on this channel is that if you have the opportunity today to perhaps do a kindness for someone, please consider doing that. It makes the world a better place. And after you've done that, come on back down here tomorrow. Join me at the beach. We'll talk about something else. If you like this video, here are a few others you might try, and don't forget to subscribe. Have a terrific day, guys.